This is data that this is the first time I've been able to put it together and share what I think is like deep in my soul about why I love this asset class so much and why I love Jacksonville so much. It's when you're sitting in my seat and you know all the other different markets and you know which markets are good for certain things and other things, right? And I have the access to all that information. I know why I love Jacksonville so much, but it's been hard to compile all the data objectively to paint the picture because real estate can be complicated. You got different property insurance costs in different markets. You got different property taxes in different markets. Obviously, you need to have some information on rents and all this good stuff. Well, here's the deal. All of that complicated process we were able to do. We were able to get it together, all that data together through the help of our consultants. And I was able to put this together. And as I was going through this late last night and putting the finishing touches on it, my vision was I wanted to share what's deep in my soul, why I love this so much, and make it easy for you all to see it as well. And so it was really cool as I'm going through and putting the data here. I'm like, okay, cool. This is telling the story that I have known for so long. This is clear. This is easy to understand. And so I'm super pumped. I think it's going to help people see what we see here at JWB and what many of our clients see as the reason to invest in this asset class and why to choose one market maybe over another.
Love that. Where did you go to find this stuff, man?
Well, so it's kind of a two-part answer here. The best way to get objective data here is to pay a consultant to get it. And so we have a great relationship with our consulting firm. It's John Burns Real Estate Consulting. John's been a guest of the show. It's kind of the industry standard for our space across the country of providing this high-level data. It's tested, it's validated, all that good stuff. But yeah, so there's that information. What I also wanted to share with you is that as I'm going through this information today, there are places that you can get really good data and kind of put the information together for yourselves so you don't have to go and spend money on a consultant. So we can kind of get into some of that, right? When we're talking about rents and home prices across the country, Zillow is a pretty good source of data there. They have per market information. Zillow on an individual property basis, I wouldn't use that to make the decision on their Z estimate of what the property's worth. But when you're comparing an entire market, it actually is pretty good information. So you can get good information on home prices, rents from Zillow and some of the major aggregators like them. You can use the US Census for rent information. It's a little bit lagging, but it's the US Census, so it's strong and validated there on the rent side. And then for home price appreciation, you'll want to go to the Federal Housing Finance Agency website, all free, of course. But they have a home price calculator tool where they actually show you, and you have to do a little bit of the math behind it, but you can actually get the long-term historical trends of what home price appreciation is per market. And these are all free resources for you to use as well. And so that's what I would go if you don't want to spend the money. Or you can just keep showing up here on the show. I use all the data that we spend money for, and I use it to, of course, prepare for our shows and share that with you all too.
All right, cool. So let's get into this presentation. Here we go. It's right here, GC. So,
all right.
You're about to throw some numbers up there.
Yeah, we got the typical lawyer speak here, right? Listen, I've used a lot of this data. I'm calculating returns on investment and profits over a long period of time. Anytime you do that, you should do your own due diligence in addition to listening to what we're talking about here. These are estimates. They're not guaranteed. We're not financial advisors. We're not offering financial planning advice. And with that, here's my thought process. Okay. My first thought is, as a newer investor, somebody coming into this space, you might be saying, well, what part of the country should I be investing in? Is it better for me to be investing in a market out in California or New York or Atlanta, Cleveland, or Jacksonville? What makes one of these markets better than another? And so I wanted to start to go through that thought process. And what I did here is you can see the different cities here: San Fran, New York, Atlanta, Cleveland, and Jacksonville. And I broke it out by the median sales price, median gross rents, and a few other things. You'll see that I specifically noted SFR workforce median sales price. That stands for single family residential and workforce housing, because what I'm doing is I'm normalizing the investment in JWB assets in Jacksonville to that same type of investment in many other cities across the country. So these are all single family residential workforce housing median home sales prices, which are below what the normal median is. And it's objectively standardized to do that. Same thing for median gross rents. This is specifically for single family residential workforce housing. Median gross rents as a way to standardize and normalize across the country. You see the total initial investment, that would include your down payment and your closing costs for one property. So you can start to see the difference between the higher priced markets and how much money you have to bring out of pocket to buy one asset versus the lower priced ones. And then you start to see some average annual rent price appreciation and average annual home price appreciation. And this information comes back for 30 to 40 years. The data goes back and we start to see how much have rents and home prices appreciated in those markets over the long haul.
Got it.
So if you're thinking, okay, how's my money going to best perform? You would think that higher rent price appreciation and higher home price appreciation is a signal there. You probably want to have your money in places where there's higher of both of those. But does that necessarily equate to a higher return on your investment? Because if you had to put out so much more money, but you got more home price appreciation, is it worth it? Does it have a return on my dollars for putting it out? So while this information really sets the stage and sets the table for the market metrics here, we need some additional steps for us to actually figure out where's the best place for me to put my money. So I think that's my job here. That's our job at JWB, is to help people go from how do I do this asset class to where do I invest, and why does that make sense? Why is that going to deliver more of a financial return and a better risk-adjusted return for you?
Got it.
So here's what we did. We took $483,000. Let's say that you had $483,000, Pablo, and you're going to buy and hold on to a portfolio of single-family rental properties in any of these markets, and you're going to do it for 20 years. We're looking at which national market delivers the best risk-adjusted return on investment. Risk-adjusted is really important. We'll talk a little bit more about that. But when you start to actually break it down, and the next thing for us to do is actually break it down into the 5 profit centers, you start to see where some of these markets really win and where some of these markets don't win. And so you can kind of decide, okay, which is the right market for me? Which might have higher total profitability, but have more ability, more risk associated with it, right? One example of that might be San Francisco. Okay, San Francisco, we know, is, if not the highest priced market in the country, it's certainly one of the highest priced markets in the country. And when you have high home prices, even though you had high rent price appreciation, you have high home prices, really hard for your assets to produce positive cash flow for you. And it starts to add up. So over 20 years, if you bought one investment property, which is that $483,000 investment in San Francisco, can you read that number for me, Pablo, of how much net rental income you're losing over that time period?
Yeah, it's a number in red and parentheses, which means you're in the negative $722,000 in net rental income.
Yeah, I'm just doing the math in my phone here. That's $36,000 a year of negative cash flow. Yeah. That's $3,000 a month. So when we talk about how, and all that is risk. Anytime you got to pay money out of your pocket, that's the riskiest thing you can have, right? So there's that risk that's brought to that San Francisco type of investment, which is a reason why most single family rental property investors don't even have San Francisco on the radar, right? We're not thinking about San Francisco as a play for single family rental properties because there's just too much risk, specifically because of the net rental income.
Got it. And if you go down the line, New York also has $712,000 in loss of cash flow. Atlanta has $131,000 in negative cash flow as well. And shockingly, Cleveland has $243,000.
How about that, huh?
That shocked me the most, because we always keep talking about how Cleveland doesn't have a high home price appreciation, so people go there for cash flow. Why is this, GC?
Well, so part of this is the way that I built this to be objective and standardized across. I assume that there's 35% down for these investment properties across the board, and a 6.125% interest rate, which is what we're able to get for JWB clients and what I would assume you could get in some of these other markets. That's that 35% down is a percentage there where, year one cash flows in any of these markets here, year one cash flows are negative, right? So at 35% down, and it's just the way the data transpires. JWB properties are cash flow positive, but just the way to be objective, these are all negative. And so it took a lot longer for Cleveland to get cash flow positive than Jacksonville or even Atlanta or some of these other places.
Yeah.
Do you know why that is?
Why?
Go back to the other slide. Go and look at Cleveland, 2.7% annual rent price appreciation versus every other city on that list, right? The amount of rent price appreciation over 20 years is significant. And so because Cleveland rents do not increase as much as some of these other markets, they actually lose compared to the net rental income of some of these other markets over the long haul, over 20 years. So when you're thinking about this type of investment, you should be thinking about a full market cycle. Everybody day one is like, oh, well, what's the cash flow day one? What's the cash flow day one? Well, guess what? The big things that you should be looking at is, of course, cash flow day one is nice to know, but how much does my rent grow over time? Because if you start out cash flow negative in one market, but it doesn't grow a lot, then this is actually going to be a negative cash flow investment for you over the long haul, which is what we see in Cleveland. Now, let me give a caveat here. This isn't to say that you can't find a positive cash flow property in Cleveland or Atlanta, because you can. This is the objective, standardized way to look at it for single-family residential workforce housing. You could put more of a percentage down to be cash flow positive in some of these markets or another. So don't let that be the takeaway that it's impossible to find positive cash flow in these markets. But if you're using one standard approach across all of these metrics, this is really the standardized way that it shakes out.
Got it. So, just to kind of summarize the bottom lines here, San Francisco, you get a total profit of 2.2 million at 7% IRR. New York, you get a total profit of 1.3 million at 5.3% IRR. Atlanta, you get a profit of 1.5 million at 6.7% IRR. Cleveland, you get a profit of 901,000 at 4.7% IRR. And Jacksonville, you get a total profit. Jacksonville, we didn't even mention, Jacksonville has positive cash flow, right? Like positive cash flow of 122K and total profits of 2.11 million at an 8.7% IRR. Is there a reason to not do Jacksonville? Like if I'm looking at this thing and I see a higher IRR and I'm seeing that this thing is cash flow positive, if I'm investing in like net cash flow negative housing, I'm assuming I either have other supplemental income that is going to like make up for that cash flow. I have a very high salary of expendable income, so I'm not super like risky on that. So I could see why I would go negative. But the combination of negative cash flow and lower IRR, make an argument for another market.
I'll make the argument for San Francisco. Okay. Let's say that you are all about home price appreciation. And in San Francisco, if you have the ability to weather the storm for net rental income, you're going to see $3 million of home price appreciation based on what has happened in San Francisco over the last 40 years as far as home price appreciation. But if you wanted to make an argument for the San Francisco market, you could say, hey, listen, I'm down to take the risk. For every 1% additional home price appreciation now that happens, maybe more than what's happening for the last 40 years, you're going to have a much bigger payoff in San Francisco than you would for any of these other markets. So if you really are able to take on a lot of risk, if you have a lot of net rental income, you could say, well, that would be the reason to do it. But it doesn't make a whole lot of sense once we step into the risk-adjusted return on investment conversation. I don't know anybody who's doing that, right? I don't know anybody who's making that decision because in my mind and most people's mind, the risk that you would take on to go 700 grand negative over 20 years is not worth you banking on there being a huge pop in additional home price appreciation in San Francisco that you haven't seen. At the same time, people are leaving California, the state of California. So there's that demand is certainly to be questioned.
Yeah, it wouldn't be, I guess somebody would doing it isn't making a numbers decision. They got to have a hunch on something else, right? Like maybe they're like, well, San Francisco right now is depressed and I can get a deal or something like that, right?
This is macro data here, right?
Okay.
This is to give a viewpoint of a 30,000 foot viewpoint of where your dollars can best serve. If you happen to know, some inside information about something that's going to happen and it's in San Francisco, maybe that's the reason you do it. But from an objective 30,000 foot view, it doesn't make a whole lot of sense.
Interesting viewpoint.